Joining our closing bell exchange today, Kim Forrest from Pitt Capital Group, Keith Bliss from DriveWealth, Sarat Sethi from Douglas C. Lane and Associates, and Rick Santelli at the CME in Chicago. We should also update you, we're down about 150 points on the Dow at the moment. As you can see, they're down about 0.5%, S&P down 0.3. The Nasdaq, which underperformed last week, is holding on to the flat line. The low of the session for the Dow was down close to 200, so we're off those lows. Keith, sum up the sort of market sentiment for us today. I guess it has been more positive than people have expected with these extra China tariffs going into play. And today we're seeing a little bit of effect of that.
Yeah, a little bit, because China they finally kicked in, and China will retaliate. We know that, and they're making a lot of statements about how the U.S. is now not playing fair or bargaining in good faith. And that's going to have a bit of a cooling effect on the market. But also, let's bear in mind the context of where the market has come from. And it's not unexpected, regardless of tariffs, regardless of news on Rod Rosenstein, regardless of continued dysfunction within the executive branch of our government, that we would see stocks take a little bit of a pause here. We need to bear in mind that we have a pretty low volume day. It almost has the smacks a little bit of a summer Friday or a summer Thursday here. So I wouldn't play too much into it. I would expect some consolidation in the market. We'll clear out all this noise, which we've done for the past 2 years. And I still think that the equity markets march forward and positive for the rest of the year.
When you get a headline, Sarat, like what we heard today with Rod Rosenstein, first a report that he was going to verbally resign, then it seems like maybe something else is going on. As an investor, what do you do? And how do you read those kind of headlines as they relate to the Mueller investigation, the presidency, and policy and the market impact?
So it's a combination. It's noise, but it's also disconcerting in the sense that there's no clarity here. So as an investor, if you're taking a longer term view, you don't really do much in terms of the sell side, but if you look for opportunities in the market side. But I think you add that today, and then you the uncertainty on oil as well. So the combinations of what kind of you mentioned, everything in there, a day, a week, really, when we don't have a lot of news on the earnings front. They really start in a couple of weeks. So you could see the market go sideways to down, especially after this run that we've had for the last couple of weeks, where only things have been going up.
Kim, if we did see the president fire his deputy AG on Thursday, what would the market do?
Well, I think it would dip. And there's great reasons why. We really don't know what this means politically, and that's the issue. Like, would this be the road to impeachment that a lot of the opposition party are looking for? There's so many unanswered questions, and the markets really hate uncertainty, and that would be a big point of uncertainty.
Rick, do you see any reaction, whether it's in the dollar or the bond market, to any of these sort of noisy headlines around Washington? Not just today, but we've gotten them in the past as well.
Well, there's always vibrations, but there's really no lasting movement like treasuries today, like the dollar today. And stocks, certainly they will be affected because they have so many key issues and they are doing so well generically for 2018. But I'll tell you what, you want a big reaction? I can still hear that famous economist that works for the New York Times on November 9th, 2016, saying that's it, bye-bye to the markets. Well, it wasn't bye-bye to the markets because the markets were saying goodbye to an administration and a party that just didn't look very favorably on business. I can't tell you what today's headlines are really going to do to investors, but I can tell you this. If this leads to the Republicans losing the House and the Senate, and this president is impeached, the market will satisfy that New York economist's notions from November 9th, but it will do it after the midterms.